Have you ever wondered how a bank can afford to pay you interest on the money that you put into your savings account when you technically haven't done anything to earn it whatsoever? Welcome back to my channel. My name is Reese, and in today's video I'm discussing how a bank can afford to pay you interest on the money that you save in your bank account. Banks offer a wide range of products and services, ranging from transaction accounts, savings accounts, home loans, car loans, personal loans, insurances, and currency exchange. A bank is its own business, and its business model is to make money. So how does a bank profit from paying you to use their services? It costs them a lot of time and money to have people manage their infrastructure to allow you to deposit, withdraw, and move your money easily. There are a lot of behind the scenes processes that a bank needs to manage in order to keep this running smoothly 24 hours a day and to be accessible worldwide. And the cost falls directly and entirely upon them. I'm just going to shed light on a few of examples that would fit into these categories of either someone being face-to-face or someone managing it from behind the scenes. So let's start with, for example, someone behind the scenes. It would be people like your software developers managing the banking apps and the online website for you to be able to use those services. It would be people managing the ATMs. You don't see someone in the ATM feeding you money out the slits every time you withdraw money. That is a process that someone has to make sure is fully functional and serviceable. You would have people opening your bank accounts, doing the paperwork behind the scenes again, then face-to-face. So you would have people in a branch who you could actively walk into a branch and say, I want to do X, Y, Z, whether it be deposit money, withdraw money. That's a bank paying a person to fulfill a service for you, the customer. It's so simple for you to walk up to an ATM and withdraw money, or log into your online banking and see all of your banking details, or walk into a branch and be able to ask someone a question face to face. But all of that comes at a cost. And these are all good examples of costs that banks need to front in order for the whole system to function effectively. So again, I reiterate the question, how on earth are banks able to say to you, come and give us your money and put it in a savings account and we'll pay you to do that? We'll pay you to make sure your money is secure, it's guaranteed by the government, and it's easily accessible anywhere in the world through a little piece of plastic so you don't have to worry about carrying cash on your body. So now again, I'm going to sidestep and deviate before we get to the actual answer, and let's understand how banks make money, because all of these three things, which is how banks make money, what their costs are, and then how you play a part in this role, all come together as to the answer. So how do banks make money? Banks make their money through a few different avenues, but one of the main ways that they make money is through lending. They will lend money to someone to go off and do something with that money, and they will charge them an interest rate higher than what it cost them to borrow it. So this is one answer to the question. So they lend money to person A, and person A has to pay them that full amount back plus some interest. So the bank will charge them more interest, like I said, than what it cost them to borrow that money from somewhere else. And now what happens is they will generally work out the difference between the fees associated, and they will work out the difference in the time that it's going to take you to pay it back, and they will charge them an interest rate which makes them profitable. So as an example, let's assume you put $1,000 into a savings account and the bank offers you 1% interest, which is currently more than what you would get for any bank in Australia. It's the lowest they've ever been, and it's not a good interest rate whatsoever, but that's not the point. Let's say they offer you 1%. For that year, you would earn in interest $10. From here, the banks would take your $1,000 and loan it out to someone for 4%, which will earn them $40 in that year. When they pay you your $10, they would be left with $30. Now let's assume they have $20 worth of expenses to pay. Therefore, the banks would profit $10. Now imagine banks doing this with billions of dollars. The concept here is that the $10 might not be that much for a profit, but when you factor this in across the board of billions of dollars, the profit margins are huge. And on top of this, at the moment, our economy is in a bit of a shitty situation. The world is in strife and everything's gone downhill, so their profit margins are small. But when interest rates are high, their profit margins are high as well. Like I said earlier, banks also provide a wide range of services, and they can charge fees for these services. These types of charges and fees would include things like account keeping and service fees, overdraft fees, late payment fees, and the most common, credit card fees. Just as a quick note and a bit of a fun fact, I did a quick Google search and I found that in the US last year, there was approximately $12 billion earned in revenue for banks from overdraft fees, meaning people who had zero on their bank account and they withdrew more money than what they had in there, they were charged a fee, whether it be $10 for that overdraft fee, and they made $12 billion just in the US alone from that one small charge / fee. Here's an even scarier statistic, and that is that last year worldwide, it was estimated that the amount of money made from credit card interest and fees exceeded $200 billion. That is an insane amount of money going to these establishments for people either recklessly spending, not being able to budget and manage their money, or treating a credit card like free money. Insane. Super fun fact, there's a lot of money, but just insane. So now let's do a bit of a deep dive to get a better understanding of who decides the interest rate that banks will pay to their customers for their savings accounts. It's an approximation on 3 different factors. The first being what a bank will charge someone to borrow money from them. So if I take a loan from a bank, it's factored in as to what my interest rate as the borrower will be, as in what I'm paying the bank to borrow that money. The second would be the central bank's interest rate. So a central bank is the bank that basically lends money to our actual banking establishments, who then lend money to people like me. The central bank basically is the bank's bank, for lack of a better word. It's where money's printed. It's where an economy basically prints money. And thirdly, how aggressive banks want to be in acquiring or pursuing new customers. So they could go balls to the walls and offer crazy interest rates for savings accounts, saying, I'm putting all my money in this bank because they're going to pay me 3 times what every other bank is going to pay me. They would probably take a loss in the short term, but ultimately they would gain new customers. That means that there would be customers who would be paying fees for certain features like bank accounts and credit cards and things like that. On top of that, people generally are loyal. Change is difficult, change takes time and it's scary, so they may not be as willing to move once they're established with this bank as well, basically keeping them on as a customer for a long period of time. Ultimately, it's those 3 factors which decide what an interest rate will be when paying someone who is basically saving money with a bank. That's the overview of how those rates are decided. And finally, I just want to brush over how safe banks are, because this kind of ties into this whole discussion. Now, you may think, okay, I'm going to put my $1,000 into this bank. I'm going to trust my money with them. And what's the guarantee? If you're telling me that they're going to go take that $1,000 out of my savings account and lend it to someone else, how do I know my money's safe? Does this mean that you lose your $1,000 if the person that they lend it to doesn't pay it back? That's a really good question. And the answer is no. Banks know this risk. Banks are very well established, very clever in the way they do business. They're designed to know what their balance sheets are. And ultimately, banks know that most people who borrow money will pay it back in some form or another on time. There is only a small margin of people in that wider range of people who will either miss a payment, be late on payments, and ultimately there are very few who, let's just say, go bankrupt and don't actually have the ability to ever pay that loan back, strengthening the position of a bank where they will always be able to cover your $1,000. Your $1,000 is peanuts in the scheme of things because they've got billions and billions of dollars. So in this instance, they would either take the loss and pay you your money that's owed because it's nothing to them in the amounts of profits that they make, or generally over time, the person who failed to pay that money back will be able to pay that money back. And the way that it's super clever, again, is that you always have access to that $1,000. They don't take it, lend it to someone, and you have to wait for them to pay your $1,000 back. Your $1,000 is always there, but on their balance sheet, they have $1,000 they can lend out to anyone at any time, knowing that every week in interest repayments, in fees and charges, they are getting all of that money back and they're able to pay you your interest for the whole year and not even have to think about it, but still on repeat be able to lend that money out, which again makes banks such a fantastic business model because essentially the infrastructure in place and the way they're established is just insane. They are so good at making money that it's frustrating because it's amazing. It really is amazing. On top of this as well, a bank who is going to lend money to someone will go through a pretty extensive application process. And this happens for everyone now, including myself. I went through this process when I bought my house. The bank that I borrowed from, it was a couple of months of process and paperwork to make sure that the loan that I'd be taking, that I would be able to service that loan, which is responsible. Additionally, most countries now have a safety net in place to guarantee people's money. In Australia, any of my money in a bank account up to the value of $250,000 is guaranteed by the government. So if all of the banks went broke tomorrow, any money I have in a bank account with a specific bank, and this applies to lots of banks. So if I had money in 4 different banks, as long as none of those accounts exceed $250,000, I would receive that money back from the government. Meaning if a bank were to go broke, like they did in the 2007 global financial crisis, my money would be safe as I would be able to get that back from the government. And that's pretty much it. That's the rundown of how banks can afford to pay you money for having your money trusted in one of their savings accounts. Ultimately, the banks use your money to make them money, which then they can give you a small portion of the profit that they make, thus continuing the cycle of how they make lots of money and you make a little tiny bit of money with the guarantee of your money being secure and safe. I hope you enjoyed today's video. I hope that I explained the topic in a way that makes sense. I tried to break it down in simple terms. If you did enjoy, please consider liking and subscribing. It really helps the channel. And as always, I will see you in the next one.